Hello and welcome to the latest episode of the Climate Trends podcast. I'm your host Shitiz Jha, Research Associate Climate Finance at Climate Trends. As we head into COP30, one key question is front and center for governments, investors, and businesses alike. How do we turn climate commitments into clear, bankable investment pathways? Today, we are unpacking transition plans, what they are, how they work, and why they are fast becoming the backbone of credible net zero action. Joining me is Ms. Neha Kumar, Head of South Asia at the Climate Bonds Initiative. She leads the initiative's work on sustainable finance, policy, and taxonomy development across the region and brings deep experience on transition planning, disclosure frameworks, and the tools that make finance actually flow. It's a pleasure to have you with us today, ma'am.
Thank you so much, Shitij. It's a pleasure.
Wonderful. So let's get right into it.
Yeah.
To start off, how can transition finance be structured to effectively support hard to abate sectors in moving towards net zero? And linked to that, what do you think distinguishes credible and time bound transition strategies for those that risk being labeled as greenwashing?
Okay, now that's a huge question. And like you said, it is directly getting into the weeds of it. But Shitij, allow me to step back a little. Let's look at the big picture. As you mentioned, that COP is around the corner. And we have to see where we have traveled since 2015, right? It's 10 years of signing the Paris Accord. So first of all, we have to say that I think huge progress has been made on energy transition. And if you look at 2015 and now, IEA, we held recently a discussion with IEA and their new report, which is on world investment, energy investments. It has some very, very promising and interesting numbers. And I would like to quote a couple of those numbers. So one is that in 2015, the ratio of clean to fossil investments was 1:1. In 10 years' time, it has shifted to 2:1, by which what you mean is that for every dollar spent on fossil fuels, $2 are spent on clean energy. So that's progress. That's definitive, clear progress. Also, if you look at, I'm setting this broader context because this will tell you how opportunity has grown tremendously, almost exponentially, Kshitij, in the last 10 years. This is not to say that there aren't bumps on the road. This is not to say that it is all very easy. And in fact, for emerging economies, it does bring a lot more challenges simply because they have, in terms of their wherewithal, they have a lot more constraints than the developed economies. So I'll give you a couple of numbers, and I'm just simply quoting them right from our conversation that we had recently with IEA and some experts here in Delhi at an IPFP. So if you look at the global electricity trends, and I would also come back to how, India is faring. So one thing is very clear, and this will keep on coming back in our discussion as we move forward, that China, in fact, has powered green transition and continues to do so. This means a lot for other emerging economies, and it also means in the current context of volatility, market volatility, shifting geopolitical order, etc. Actually, how do we manage our transition? How do we keep it apace? And how do we bring the capital that is required to finance and transition? So if you look at the boom, right, you can see that electric vehicles are, on an upward trajectory. They have increased their sales from 1% to 20% of global vehicle sales in these 10 years. Variable renewable electricity, which is wind and solar, it has grown from 2% of generation to 2015, in 2015 to 15% in 2025. Electricity's share itself, in the final energy consumption, it has risen from 15% to 20%, and it is projected to reach 25% by 2030. So literally, it is the age of electricity, as you might want to call it, an age of transition. And these transitions are simultaneous. And now in our talk today, broadly, I would like to focus or build the framework. When we say transition, what do we mean by transition? And I will call it climate transitions, within which there is energy transition, there is agricultural transition, there's a whole lot of sectors which need to be looked at when we understand transition finance. So now coming back to your question, when you say transition finance, Kshitij, um, I want to again step back a little, and I want to clarify a couple of points of confusion which I see in the community of practitioners, even think tanks, when we talk talk about transition finance. So, what exactly, or how should we understand transition and transition finance? So, Kshitij, you would agree, and this is a simple way of understanding it. It is something that Climate Bonds spent a lot of time on. And in 2019, we released a white paper on the conceptual framework of transition finance, and even how should we look at labeling certain financing measure as transition. So you would agree, Kshitij, when we say transition, that everything needs to transition to green, right? I don't think there is a confusion around that aspect. Second part that needs to be understood is, what does green mean? And I think here sometimes people differ, and people also try to put transition as a separate category, but in fact it isn't. So what does green mean? By science, by IPCC, green means that you have to limit global temperatures and global warming to ideally under 1.5, but if not that, then well below 2 degrees centigrade. That's what the Paris Accord says, right? Then it also says that to be able to do so, somewhere by mid century, we have to be net zero. Okay? So everything has to transition to green. And another term that comes into play is net zero, that everything needs to come to a net zero by 2050. Now, this is science. Okay? The other part, which is aligned to this, but is underpinned by stages of maturity and economic development, are these net zero years. So China has, for instance, 2060, India has 2070 net zero year. So when we are saying transition to net zero, our trajectory that we are defining in India gets pegged to 2070. But the science and the underlying logic should be understood very, very clearly, which means that transition is, in fact, or transition finance, in fact, is a subset of green finance. And this is how Climate Bonds looks at it. The other thing that, I can again unpack it a little bit and then go into, the parts of your question that you've asked, is that if you look at this overall umbrella, then you would agree with me that some activities are already near zero or net zero. What are these activities? This could be, for instance, solar and wind power generation. We know that these are already activities. Some will call them dark green, or they will say, but these are near zero activities already. So that's a first category. Okay, still a part of green transition. Okay, still part of financing the transition. Okay, now second is the set of activities where we know that they can be aligned to a pathway to zero, but do not yet have a viable tech alternative. So here in this category, you would include what we know as hard to abate sectors. And for the benefit of our viewers, just to clarify what hard to abate sectors are, generally these are, coterminous with industrial sectors like steel and cement and chemicals, where a lot of process change has to happen, and technologies which are green are not yet available in a viable, economically viable way to be inducted into those production processes. But this category is of sectors where transition has to happen within the sectors. I want to make it very clear. Okay. The third category of activities, Kshitij, would be those which you have to either move away from completely. These you would know because they cannot be aligned to global warming targets. These would be classified under, say, coal fired or fossil fuel fired power generation and everything that comes with the with fossil fuels. Okay. The second part or some other activities that are still within this category are those which are required only in the interim, like changing municipal waste into energy. Those are extremely bad technologies right now. We will not need those technologies, and we will not need to the way we do this kind of activity will need to change, or will need to be simply be phased out with the advent of new technologies. Now, these categories are categories from which we have to transition away from. So, if this framework is clear, then we can come to the question of, okay, so how are we transitioning within sectors? What are those ways in which we can transition away from certain ways of producing energy or some other technologies? And then you would come to also realize that it is not the action which is has to be taken only by corporate sector. It means that it requires real economy policies, it requires corporate strategies and actions, it requires financial strategies and actions. It, in fact, even requires, like you said, alluding to what the focus of COP is, national climate action slash transition plans. So it is something that will not happen only on the basis of action by one set of actors, right? It really requires a very, very comprehensive way of looking at things. So, going now to your second part of the question, uh, uh, and if you would repeat that, you would say, how do you make it credible and robust, right? If I can, if I'm correct in
Yes,
paraphrasing what you said, huh? Is that right, Shitij?
right.
Okay, okay. So, um, so one part of the answer lies within your question. How do we make it credible? I explained if you stick to science, you'll probably be able to make it. Not probably. This is the way to credibility if you stick to science. What would that mean? And how is that getting done? Uh, let's deep let's deep dive a little bit into this. We start looking at how are transition finance instruments? What are the kind of transition finance instruments? What is the way in which credibility can be ascertained? And what's happening? Just what's the state of the play? Okay. Now, everybody has heard of green bonds. Um, and the new term called transition bonds and sustainability linked bonds. Let me demystify this a little bit for our viewers. Um, Transition bonds and green bonds. So first of all, what are green bonds? And because that will make it easy for to come into all other kind of instruments. And if I digress, bring me back to it, Shitij. I do want to talk about transition plans as an instrument because that's absolutely critical to actually getting access to finance for financing transition. Okay, so green bonds, uh, first of all, they still dominate the canvas of thematic debt. So 61% of all thematic bonds, loans, issues are labeled as green. So they are the dominant category. They're also the parent of all other categories. Okay. The difference between green and what we want to understand whether this will be applicable for transition is twofold. Okay, I want to cover 2 points underneath this. So, like I said, near zero activities could easily be labeled green, and hence a green bond can be issued, by which we mean that the asset that we are raising the money for, we there is transparency in the allocation of proceeds. This is, in a way, is called a use of proceeds instrument. So the proceeds are allocated to the asset. That asset is already near zero, and hence it is called green. Correct? Simple understanding. Okay. This has developed as a very mature instrument. It has been issued by corporates, by sovereigns, by banks, by all kinds of types of issuers. We know about that. Nearly 3.4 trillion only of green bonds exist in globally today, and this is a massive leap since they were first issued, which was just about $2 billion 15 years ago. So exponential growth, and hence also the surge in other thematic bonds. The beauty lies in two things: that it is very, very simple in structure. You don't have to create a new instrument. Everybody knows what a bond is. You have to make it green. It's a bonus feature. You have to be transparent. Can we then look at other activities which I just explained and say what kind of instruments can be useful? Now, in transition sectors, for example, steel, you could use a use of proceeds type of instrument and call it a transition bond. Transition bond is nothing but a green bond in a transition sector. There is a difference, which I will just tell you. It is a use of proceeds bond. I'll give you an example. If you have to raise money for electric arc furnace, then you have that asset which is very clearly near zero, and hence some investor may even want to call it green. They may not even want to label it as transition. Okay, it is as simple as that. But there is something else in the transition universe which now starts to become important. Transition it has to happen from point A to point B. So the entities which are transitioning become important actors. And when entity level transition is being considered, you want to know what that point A is and what that point B is. So you want to know their transition strategies, you want to know their targets, you want to know their implementation plan, you want to know their transition plan, which also contains an investment plan and a business plan underneath it. Now, this becomes a full framework of transition. Okay. So transition bonds do not ask generally for a transition plan. They will ask you for your transition strategy. You should be able to give that. It is more akin to a green bond, okay, as a use of proceeds instrument. Where do all the rest of it becomes important? So a steel company would say, look, or I don't have so many electric arc furnaces, but I really want to dip into this capital pool, which preferences sustainability. So I want to get onto this bandwagon. I want to access finance to transition. So then the investors will ask, and then the framework setters like climate bonds, like many others, like TPT, they come into play and say, okay, fine, this makes sense. Let's assign it a label. We'll call it transition. We'll call it sustainability linked bond or loan. Okay, but what will we do to ascertain that it is robust? We will say you determine your sustainability target, which could be the reduction in emissions. You set some KPIs, you set your performance targets accordingly, and then your payment to that bond, the interest payment will be it will be tied to your performance on your targets. So if you perform well, you will have to pay less to your investor, and if you're not able to meet your targets, you will have to pay more. So this is called step up or step down in the structure of the instrument. And that is why, because these loans or bonds, that this kind of borrowing is generally general purpose, which means a company takes it and it will say, let me see where will I have to use this money. But I am telling you that by the end of a certain period of time, which is usually the tenor of the bond or the loan, I will have reduced my targets, and if I don't, I'll be able to that penalty is included in the structure in the form of a step up. So this is important. But then you said, how do you make it robust? If the borrowing is at entity level and for a general purpose, there is no other way, Kshitij, to make it robust than having a robust transition plan. Now, I said that these kind of transition plans are being put out. The framework of the how they can be looked at as in a credible manner are being put out. And I will mention what Climate Bonds has done, and it has basically studied a lot of these frameworks, and it says three things. So, and this is about the corporate transition plan framework. Okay, there are also frameworks around financial institutions, transition plans, and now also we are saying that even sovereigns should actually have a transition plan, which basically means that you should know where you are headed. Your NDCs can be pegged to the transition plan, but then we would like to see a very clear plan of action, very very clear governance, very clear fiscal strategy, very clear kind of investment plan to back it up. So this is very much possible, and I will talk to you about a couple of things later on, if we come to that, that even countries can issue such kind of sustainability linked bonds and can have transition plans. But coming back to the corporate, right, because it is the real economy transition that we are looking for. So it is really at the base. Three things matter: ambition, action, and accountability. Let me give you just some components of ambition, action, and accountability. And of course, you can unpack all of these terms. But I'll give you certain dimensions to unpack them into. So ambition is basically performance targets. Okay, you can have clear categories, that you can have mitigation targets, you can have resilience targets, you can have even nature based targets, you can have just transition targets. So there is basically it is target setting. Okay, then you have a plan. You have that plan has to have basically a narrative. For corporates, it should be able to cover all scope of emissions, like 1, 2, and 3. Scope of GHG emissions. Then it should be able to have any other kind of performance targets. There should be an internal policy, and there should be a governance internally, and one should be able to do some kind of sensitivity analysis and put it in a strategic narrative of the company. Okay, this is how you can, these are the ingredients, broad ingredients I'm talking about. But then it has to be substantiated by action. The piece of action that requires clarity is that you have long term uh, trajectory, but you have interim milestones, and you have annual verification of progress. This is the action part, without which we would see that if we have to look at a transition plan being credible or robust, we will go for these kind of ingredients being clearly spelled out. Then, without accountability, no plan actually is worth its salt. And that accountability comes from two things: governance and disclosure. So you would have, clear responsibility within the corporate structure. The board should be able to sign things off. Any kind of corrections should be able to be met in the relevant committees and the board. And then you should be able to disclose internally as well as externally. So this is transition plan, and I really wanted to spend some time on it because when you issue an SLB, which is a general purpose borrowing in the form of bonds, you would need a plan to back it up. That is the most robust SLB structure. You would need to have targets which are ambitious. How do you decide ambition? You can't say, I'm just ambitious because this is my best. You will have to at least look at the sector best and what is, and if you are basically also raising money from offshore, then your investors will tell you, by the way, what you are saying is actually low in ambition. Uh, According to science, according to some calculations in your sector, this is the best, So those are the kind of things which will come into play. I'll take a pause over here, Kshitij, for you to, ask me further questions, supplementary questions, but I hope I have made the bigger and the broader point clear at this point.
No, definitely. And I think you've highlighted some really important numbers and also an important distinction, especially when we see so many transition claims floating without clear accountability. And I'm really happy that because you went on full comprehensive mode, you answered the next two questions that I had for you, which were about how do financial institutions using client engagement and disclosure frameworks, which you mentioned, even which climate bonds does, and also about what are the non-negotiable components of a transition plan, where you mentioned the three A's: ambition, action, and accountability. So yes, I mean this is great because on paper everyone's got a plan, but very few actually are investment ready. All right. So, moving to the next segment, what does an effective transition plan look like in practice, particularly for companies in carbon intensive sectors? And how can accountability, which you just mentioned, transparency, and risk management be built in beyond just box ticking exercises, compliances, and connected to that? Do you seek disclosure mandates from SEBI, RBI, IFSCA, moving towards convergence with global transition planning frameworks?
Hmm. Good question again. Okay. Let me begin from the final question that you asked. How are our regulators enabling credible transition plans? Now, I think there is a very active thought which is being given by some of our regulators. I will say I will take Reserve Bank of India and IFSCA's name here much more prominently. Um, Reserve Bank of India, as you would know, had released its draft disclosure guidelines in 2024, which is undergoing as we speak. There was a consultation around it, and it was basically meant to be applicable to the regulated entities, which are scheduled commercial banks, the AIFIs, and some NBFCs, etc. Um, that was about two things, and they are important to mention over here. Um, it was about managing risk, emanating from both the physical aspect of climate transition as well as the transition risk, and it was to also look at how banks are not only realigning their portfolios and reducing their risk methodically, but what are the opportunities they are pursuing to finance? Okay, and if you look at it comprehensively, it is the whole gamut of transition. Okay, so it isn't saying that only steel or cement needs to be looked at in terms of risk or finance. It is whole gamut of transition sectors, transition activities. As I keep on coming back to this important point because people only tend to think of transition as being applicable only for steel and cement. It is not so. Every sector is transitioning, as I just mentioned. But coming back, what did they do? So they did mention in their, they had basically divided and that's a draft, and we do not yet know what the final format would look like. But in the draft, they had divided the disclosures into two: baseline disclosures and enhanced disclosures. And they had said that if you have a transition plan, then tell us on what scenarios it is based. But it was only this much. It was a statement. If you have a transition plan, okay. Now, when and the other thing that I want to talk to you about is that transition plan is not a separate activity. Everything that you're doing towards transitioning, target setting, talking to your customer base, engaging with your clients, all of this together becomes part of your planning exercise. It helps you do a bottom up, sort of evidence backed target setting. It also gives you a structure and strategy and make you understand your business plan, etc. So people say, oh, transition plan is a separate thing. No, it isn't. Um, Even calculating your financed emissions for financial institutions, it becomes important, right? Because it is through their loans, it is through their investment, and all of those activities. They can facilitate, they can finance those emissions. So their counterparties become important. They have to know how much exposure do they have to a counterparty, and hence they have to calculate financed emissions, which are usually scope 3 emissions, and then they have to see how can this be reduced and financing increased to low carbon and less risky activities. So yes, RBI did mention, and every mention is important, as you would appreciate, but it doesn't give you what the components of a transition plan would look like. Okay. Then internationally, you have Basel. Recently, in June 2025, it came out with a voluntary framework on climate risks. And it only looks at climate risk part of it. RBI looks at also the financing opportunities part of it. And it also mentions that if you have a transition plan, tell us how you make it, give us, but it doesn't again give you a framework or necessary pillars that need to be looked at. Okay. NGFS is another institution, which is the Network of Greening of Financial System. It's basically alliance and association of a lot of central banks, and they also released what they call a transition plan package. So they also got into the components of what a transition plan would look like for financial institutions. Okay, again, they did it from a risk point of view more, and less from an opportunities point of view, but they took the two aspects into consideration. And people like institutions like climate bonds uh, came out then with the best practice guidance on transition plans for financial institutions. And because we had already worked on corporate transition plans, we also have given a tool, and I think our audience and viewers should look at these tools. They're available on Climate Bonds website, which is how to categorize your borrowers on where they are in the transition journey. So, yes, there are tools available, okay, which give you which break every part of transition plan. Like I gave you for corporate transition, there is similarly for financial institutions, which begins from commitment, then it comes from the emission targets, then it comes from your what is your delivery strategy. Are you, are you profiling um, uh, your borrowers? How is your engagement accountable? So it may be that you have a target as a financial institution, but your borrower is not either ready or doesn't plan to, or doesn't have the wherewithal to decarbonize. Then what do you do? So where does accountability set in? So those kind of things are explained in some of these tools that have recently come out, and they're very new tools. But you'd be glad to hear that actually a couple of banks in India, and here's a shout out for three banks. I would say first one is to Union Bank of India, which have not waited for whether it's a compliance requirement or what it is. They have taken it as a central strategy of how should they will look at their portfolio going forward. So all of these components that some of the frameworks are making now available, some banks like UBI are trying to do a whole lot of these building block exercises with their customers, and they are also looking at what would be what is the current level of emissions of their borrowers, what would change, and how ready they are to accommodate changes. How will their business get affected if there were new policies in the ecosystem for transition, and what is the probability of default in the business as usual scenario? What would be in the case of a transition risk manifesting in a short or a medium or a long time horizon, etc. So what I'm trying to say is that globally, internationally, these frameworks are now available. There are many organizations which are working towards giving tools in to corporates as well as financial institutions to help guide how to ascertain robustness. For example, RMI, which I can tell you, also has a way of a sort of it has systematized a way to for assessment of your transition plans and your targets, etc. But broadly, what all of these international frameworks, where they are pegged to 2050, they are pegged to some kind of science-based target setting and disclosures. Just one more point. When it comes to financial institutions looking at transition finance, then right now most of the attention is on the credit they are giving to their counterparties. Okay, but banks have a lot of other functions, right? They have a trade book. They can also facilitate they underwrite bonds, etc. So their sort of transition risk management and finance is much broader than just the credit part of it. I just wanted to make a mention of this. The other regulator which has done work on transition finance is IFSCA. They have come out with disclosure framework, and they have been very clever and smart. And I think it's a very good strategy as well. I had the opportunity, being a member of the Transition Finance Committee. Basically, they have studied all taxonomies, instruments that are, relevant and are being used across the world, and they are developing across the world, and they have given a logic and explanation of how transition should be understood, and if your investor resides in, say, EU, then they recognize, the framework that would be relevant for that investor. So they're not sort of monolithic in their thing that this is our framework, only this counts. They're basically saying the well-established, robust frameworks globally available are recognized. They name it. They name many of them. They talk about instruments. They have recently released transition bond disclosure circular. They already had NSLB, framework earlier. So they have done quite a lot of work. SEBI, Kshitij, only mentions this at a principal level. So they say, oh, you should have if you're looking at transition bond, we will recognize that as part of green debt security. So yeah, what I was saying was that SEBI has, it does say that if you have a transition plan, give it to, please do mention that. But again, there isn't a standardized framework which is right now available from Indian regulators to the companies or financial institutions. So, but generally, I think the the idea is to be interoperable. To idea is to be even though our net zero is set at 2070, we are I think the idea within the regulatory bodies is that even if they may not prescribe, I think they are very open to a good practice performance on these aspects, and let us see how it goes. I mean, even if they readily recognize third party guidance, that is also good enough. Not everything has to be built from scratch by a regulator. And I think that the smart approach would be what is available, what is recognized is also uh, you know uh, um, uh, included and is acceptable. And with the Indian taxonomy coming in, etc., that interoperability needs to be checked forth. So I would say, and I would urge, when I say this, that our general line of direction should not be for what is minimum that is required. It has to be we have to raise the ambition, because see, investment is not going to flow to something minimum which could have already been done, right? Investment is going to flow to opportunity. Opportunity is directly proportional to ambition in the case of climate transition. So this is what I would say where our regulators are. Internationally, you have many regulators who are looking at this. UK is looking at this. EU is looking at this. Then guidelines and circulars are also available through NGFS, as I had said to you. So all of these are, I would say, a very rapidly evolving landscape of regulatory guidelines and advisories that are coming through. So they would become almost a mainstream thing in a very short time, according to my assessment.
That's interesting, especially the bit about convergence that you mentioned, and there's a lot happening in the space right now. Also, what I heard and I liked is that how you mentioned that transition is not a standalone thing and should not be looked like one. It's all comprehensive.
Yes.
Now, moving on to the last segment, because we are finally now heading towards COP30 in a couple of days. What do you see as the most critical steps to ensure interoperability between different national and regional taxonomies, like you mentioned? And how important is global alignment for mobilizing large scale climate finance? And maybe some risks that you see that can arise if these frameworks remain fragmented like they are.
Okay. Um, so, first thing first, why interoperability? Because you need a common language. Because an investor needs to be clear when they say decarbonization, it is understood in a similar fashion, in the jurisdiction that they want to give their money to, or to the company that they want to give to money to. Now, Obviously, there are differences in terms of trajectories between emerging economies and developed economies. Transition by no means is a linear game. It is not also an easy play. Okay. Um, so, bottom line, that emerging economies, of course, require a lot more wherewithal in terms of uh, financing, creation of pipelines, getting more projects online, but it requires a lot of both domestic and international finance, which can be clearly identified to be going into these credible projects and activities, right? Now, so what is important at international fora like COP is actually much more defined sort of financing roadmaps. Okay. And I don't think, and I don't want to jump ahead, and I'm not any kind of COP expert. And I'm in fact much more enthused by business COP, by people trying to say this is where the investment opportunities are. So there is a whole lot of private capital action which is happening. Much more needs to happen, no doubt about that. Okay, but we have to get that into the room as much. But broadly, on at the level of negotiations, I think that's not the space that I want to go deep into. But I think there would be some kind of uh, very requisite kind of um, discussion uh, around national investable transition plans, and there should be. So how that comes about is a different matter, but I think some enablers for governments that governments can put into the system are like interoperable taxonomies. Uh, just to clarify something that you said, Shitij, um, a couple of terms over here, like fragmented system, harmonized system, interoperable system. I would like to say that I don't think uh, that the system is a system of standards and regulation is fragmented. Uh, it is not necessarily also feasible to harmonize it. Okay. I don't think if it is even desirable. You would have some certain context level priorities definitely for emerging economies, but it can definitely be interoperable. And that action is a high priority among certain institutions like UNPRI, climate bonds is also part of it. There is IPSF, which is the International Platform for Sustainable Finance. And one of their main agendas is to actually develop interoperability principles for taxonomies. This will do a lot of good for everyone involved because climate finance, any kind of finance, flows where there is common language and where there is less friction and less arbitrariness. So, if we can agree on certain structural principles of taxonomies and certain content contours of taxonomies, and keep on plugging your regional or your country level context in, then things are all right. You don't have to have one system. But definitely, the system of taxonomies or disclosures should not be on what minimum you have to do. You have to be transparent. The more transparency, the more symmetry of information there is in the system, the better it is for investment to flow. So that is what I would say for what I would expect some kind of progress on these lines. There was something else that you wanted to ask. Maybe you can repeat the question.
No, I think you answered most of it, and I feel that what you're trying to say is the right word to push for is interoperability rather than harmony. So, I mean, that brings us to the end of the conversation. Thank you for sharing such valuable insights, especially how credible transition plans can bridge the gap that's there between the ambitions of policies and also financial action. So, as we look ahead to COP30, it's clear that transition planning isn't just about disclosure, it's about direction, accountability, and making national goals truly investable, as you mentioned. So, thank you everyone who tuned in. Thanks for listening and see you next time.
Thank you so much, Shitiz. Thank you for this opportunity. It was lovely talking to you.